Welcome to today's Q Master class on Q Global Market Breadth. You already have my detail. Let's continue with the next slide. Disclaimer, this demonstration is for educational purposes only. I'm not an investment advisor. It is not a trade recommendation. Trading involves risk. You and only you are solely responsible for the outcome of your trades. I may mention about options trading from time to time. You may refer to the characteristics and risks of standardized options document from Options Clearing Corporation to decide if option trading is suitable for you. These are the Q systems. In the Q Master classes, we are going through each system at a time. Today, we are going to cover Q Global Market Breadth. That is an addendum to Q Global. It helps to look at the internals of the market. Q Global and Q Elite are technical analysis tools. They help us assess the external view, technical view, and Q Global Market Breadth, also technical view, but it is used to look at the internals of the market. Let's start. Q Global Market Breadth has a treasure trove of market internal health indicators. Each indicator provides a significant insight. Taken together, the breadth indicators reinforce each other and become extremely valuable in establishing directional bias. This is one of the secrets behind Q traders, including myself, being able to catch market tops and bottoms more accurately, more often than others. In today's topics, I'll cover Q Global Market Breadth, the underlying platform and data, which country and market we can use it, how it is organized, conventions used in plotting the indicators. Then we'll go through all the breadth signals and breadth layouts. We'll go through the charts along the way. If required, I'll open the live system. If not, I will go through the presentation to explain all the indicators in detail. That itself will take quite a long time. Q Global Market Breadth, why it is important. Successful trading depends on accurate analysis of the market. 50% of a trade success may depend on whether we are right on the market. The rest will depend on whether we are right on the industry and then on the stock. Studying the market using ETFs, futures, etc. is necessary, but not sufficient. Necessary to decide if the market is up or down or sideways. This is the outside view, but not sufficient because they do not tell what is going on inside the market. Market breadth provides this inside view using market internals. How is the inside view achieved? It is achieved by aggregating different internals. What are the internals that are aggregated? Like up down volume, up volume of all the stocks, that is volume of all the stocks going up minus volume of all the stocks going down. Advanced decline, number of all the stocks going up minus all the stocks going down, number. New high, low, new low, new high, new low, percentage. Percentage of stocks making new high, percentage of stocks making new low, etc. Now these are internals. They are not external views like we can see from ETFs or futures, they are something happening inside the market. The internals are aggregated across different dimensions or indices. These dimensions are basically indices or exchanges. NYSE composite could be one dimension, S&P 1500 could be another. So either the composite indices or the major indices could be used for dimensions. So we may aggregate up-down volume across NYSE composite, then S&P 500, etc., and then have an idea how is the overall volume picture. Is it bullish or bearish? And NYSE composite may be bullish, S&P 500 may be also bullish or not bullish. We may look at those differences also across different dimensions, that is across different indices. And once the aggregations are done, Q does some more complex calculations based on the aggregated data. Both the aggregated data and some of the Q calculated studies together forms the market insight view. They are presented along with custom indices or market indices. The market indices are the dimensions used for aggregating, and sometimes a custom Q index may be used to combine the outside view and inside view in market breadth chart layouts. These are ready-made chart layouts. After processing the breadth indicators, all we need to do is open the layouts. Examples will be chart for NYSE composite along with NYSE advanced decline up-down volume. That is one of the breadth chart layouts. That is calculating internals and then aggregating and then combining with key calculations across one dimension, NYSE composite only. And then there are other layouts like total view custom index along with market breadth total view. They are calculated not on one dimension, but on multiple dimensions. So we have different kinds of layouts. One is the total view, combines multiple indices, provides overall market breadth view, and then we can drill down into individual dimensions. It can be composite or it can be major indices. We'll go through much more detail of this in today's session. It's going to be a long session. Internal or inside view drives the outside view or indices, not the other way around. The outside view does not drive the inside view. The inside view actually drives the outside view. That is why it is important not only to look at the ETFs futures, but know what is going on inside. That is the secret behind being able to catch market tops, bottoms when the momentum is clearly bullish or bearish. We can assess that more clearly than other traders because we rely on both internal and external views. The internal view drives external view, not the other way around. Therefore, studying the internal show the true health of the market. In a healthy directional market, outside and inside views are aligned. When they are not aligned, one may anticipate the outside view to change to match the inside view, not the other way around. For example, bearish divergence between advanced decline and an index. Advanced decline is an internal. It is then aggregated on an index, let's say NYSE index. If we have bearish divergence between advanced decline and the index chart, it will most likely lead to the index pulling back. The index will not change the advanced decline. It is the other way around. Some internals are faster than others to predict market change. For example, advanced decline tends to be a faster leading indicator of market direction change than up-down volume. And that is also obvious from the indicator name itself. Advanced decline tells whether stocks are going up or down. Volume tells whether volume is up or down. So of course, advanced decline will be more leading indicator because stocks going up even on low volume will move the indices higher. So we have different internals and we know which ones are more leading than others. All the breadth indicators are visually distinct, just like other Q indicators. As you have noticed in Q Global and also in Q Elite, all the indicators are designed to be distinct. That's why we don't use labels. And Q Global market breadth does the same thing. All the indicators are designed to be distinct, or most of them. Most Q breadth signals are visually distinct from each other by design. This avoids the need for label. For example, accumulation distribution count is displayed as a count. Hindenburg displayed as warning signal, skull signal. Eureka, Phoenix are used to color the candles. They are all designed to be visually different. In some cases, multiple signals of one category may use the same visual presentation. In those cases, labeling is used. That's the only time we have used labels. For example, advanced decline, up-down volume in Nasdaq composite breadth chart, all are using similar representation, histogram-like presentation. And because they are using the same histogram-like presentation, we use labels for those cases: advanced decline, up-down volume, Nasdaq, for Nasdaq composite or for any of the other indices or dimensions. Just like in Q systems, everything is consistently color coded, Just like Q Global, green is bullish, red is bearish. Just like Q Global, there is no parameter. They're designed to be auto-adjusting depending on market moves. There is no threshold, just like Q Global. Breadth indicator levels are compared internally to auto-adjusting thresholds, and the result may be plotted on the chart as highlights. So the result may be plotted as bar to highlight something or dots as something. We don't need to compare any value with thresholds to know that some critical level has been reached. It will be alerted using a visual representation. We don't have to check thresholds. And all this make Q Global market breadth also unambiguous. Whether I'm looking at it, you are looking at it, a class 10 student is looking at it, will come to the same conclusion regarding the global market breadth charts. Absence of parameter, no threshold comparison, and consistent color coding means two people looking at the same indicator will always arrive at the same conclusion regarding what? Regarding whether it is bullish or bearish or neutral. This is irrespective of their trading experience and expertise. Q breadth charts with other Q systems, the Q Global technical charts, then Q Edge, Vital, Index, Finder, and Season, they together identify 360 degrees trades where all the forces are aligned in our favor. Underlying platform and data. Data, different categories of data is used. For example, data for mega cap custom index, that is of different category from data for NYSE composite. One is used to calculate a custom index and one is used to aggregate internal values across a dimension. Constituent stocks in each category, whether it is a custom index or composite index or major index, constituent stocks in each category are to be updated from time to time. So if NYSE composite constituent stocks change, we'll need to update the data folder. If top 20 mega cap stocks change, then we have to update the new stock coming in, the old stock going out in the data folder. This may be done only once in a quarter. These indices, whether composites or major indices or the custom indices, their constituents don't change, may be done once in a quarter. That is enough. Or if you know that Dow Jones constituents are changing, you may only update it at that time. So if you keep track of that, when Dow Jones, when NASDAQ, when Russell 2000s are being reconstituted, you may update at that time, or you may just update once in a quarter. Another example will be stocks for the leader index. In each new bull market, the leading stocks will differ. So we have to probably update it only in each new bull market, not once in a quarter. The new leaders list is to be reflected in downloader. The data for all these categories, they are downloaded into separate folders on our computers for each of the categories. Data is downloaded using the Metastock program downloader. It's a component of Metastock. That is how data is downloaded. Different categories of data, custom index or composite index or leader index, all the constituent stocks data is downloaded using downloader, and then we need to aggregate the data. Aggregation is done using FIRE. Aggregate what? For example, new high-low percentage or advanced decline. That is aggregation across different indices or dimensions. For that, we use FIRE. FIRE is a very versatile program, very customizable, and we have used, I think probably we have used it better than anyone else, at least I have seen. It's used to aggregate the data, and market breadth may be used with Metastock real-time or end of day. Either one can be used because we just need downloaded data. We don't need real-time data for it. Though in real life, all the Q traders using market breadth are using real-time data, but it could be used for end of day data also. Country market applicability, Q Global Market Breadth is available for the USA market. I may use it for the India market also. However, the full power of market breadth is available only in the USA market because of the depth and breadth of the market itself. That's the biggest market, stock market in the world. That's the market where it is most applicable. How is Q Global Market Breadth organized? It's organized in ready-made layouts. What are layouts? Layouts are collection of related breadth signals. So total view, overall view of the USA market breadth is one layout. Leader index is another layout, etc. I later on go through the use of each of the layouts and the indicators in it. So breadth is organized into layouts. We just open the layout we are interested in. Usually I look at all the layouts one by one, starting with the highest level first, total view. Then I may go to the composites. Then I may go to the major indices. Then I may go to the custom indices, mega cap, leader index, etc. Each layout has a default interval of daily. You may change the interval to weekly to see longer term market breadth patterns. The interval can be changed easily on Metastock. For example, you may watch NASDAQ market breadth using both daily and weekly. Some of the signals are more appropriately read on the daily chart. Some signals are more appropriately read on the weekly interval. So we have by default daily layouts. We may change the layouts to weekly when we want to read certain signals. For example, if we are looking for bearish divergence of advanced decline or bullish divergence of advanced decline, then we may switch to weekly interval. That will be more appropriate. I'll cover more on this later. Usually, traders do not go higher than weekly interval to study the breadth charts. I don't. I just use daily and sometimes weekly. When I switch to weekly, I'll explain that later. Each breadth layout presents distinct breadth insight. They are all distinct. There is no overlap. Just like Q indicators don't have overlap, the breadth indicators don't have overlap. Two signals never tell the same story, and the layouts are also used for distinct purposes. One for total view, one for composite indices, one for major indices, one for leader index, and then for mega cap index. All distinct. Together, the breadth layouts provide a complete picture of markets internals. The layouts may be viewed using custom menu bar buttons on Metastock. We don't have to open them one by one using file open menu. You may add them to custom menu bar on Metastock as I have done. Just click that when you want to study the breadth indicators or breadth layouts, and they will open up. Plotting a breadth indicator manually is possible, but never needed and nor advised. Just like Q global indicators. Every plottable breadth indicator is already part of one or other layout. You never need to plot an indicator manually to view it. Instead, you study the ready-made layouts. That also ensures that every trader looks at the Q breadth indicators with the exact same color, exact same shape, etc. So we can share the layouts with each other. Everybody will instantly know what is the story being told by the breadth. We don't have to change color, don't have to change size. We don't have to even plot, just use the indicators from ready-made layouts. And just like is true for Q global, if a breadth indicator is not part of any template, then it is used internally. So if you are having some programming background, you may see there are some indicators not available on any of the breadth layouts. Just like for Q global also, some indicators are not plotted on any Q layouts or templates. That is because those are to be used only internally. They are not meant to be plotted. So anything that is to be plotted, useful, they are already available in the appropriate layout. That's how it is organized. Convention, few conventions here. Some signals are with a single color. These are usually represented by lines. For example, percentage of stocks above 50-day moving average, growth versus value plot, etc. In Q global, similar line indicators will be the yellow direction line, white direction line, etc. Those are plotted using a single color. And when they are plotted using a single color, usually line tilting up means it is bullish, as in the case of percentage of stocks above 50-day MA, and it happens to be drawn with yellow color. In case of comparison internals like growth versus value, line tilting up means relatively bullish. Of course, it's a comparison indicator. So tilting up is still bullish, but it is relatively bullish, not absolute bullishness. Line tilting down will mean either bearish or relatively bearish. That is the case for signals with a single color. And then some signals are with a range of colors. These are represented by numbers. For example, accumulation count, danger signal, Hindenburg. They have range of colors. And when they have range of colors, cyan or green is bullish, Cyan is usually more bullish than green. We have used the exact same convention as in Q Global. Magenta or red is bearish. Magenta is usually more bearish than red. Yellow is usually an early warning signal, as in the case of Hindenburg, accumulation, distribution count, etc. So we have two conventions, one for signals with single color, one for signals with range of colors. Do we have more conventions? Let's see. Yes. There are certain Q signals that oscillate between normalized ranges. So the ranges will look the same across all indices or dimensions. That is the aggregation levels. They oscillate between ranges, oscillates between upper and lower limits. The limits are normalized, so irrespective of the index, the limits remain the same. For example, 100 minus 100 is the normalized range for advanced decline, up, down volume, etc., irrespective of which index you look at. Because it is normalized, it's easy to read across different indices or dimensions. Values above 0 are bullish, values below 0 are bearish for these oscillating indicators. Bullish data is represented in green, bearish is red as usual. Oscillator values beyond auto-evaluated threshold. As I mentioned earlier, we never have to decide the threshold. However, thresholds are there for certain breadth indicators, just like it is there for Q Global also, but it automatically evaluates the indicator against threshold, and the thresholds themselves are evaluated automatically based on market condition. And if the oscillator goes beyond auto-calculated threshold, then a visual alert appears like a histogram style vertical lines. Where can we see this? Advanced decline, up, down volume, new high low percentage studies have such alert vertical lines. We don't need to know the threshold. We may just note that there is a vertical line or not, and then we know that it is at an extreme high or extreme low level. We'll go through the charts later. I'm just explaining the convention, and then we'll see exactly how they are plotted. Then we go through the breadth signals. First, an overview of them. Breadth signals are of different groupings. Remember, when I covered Q Global technical indicators, I classified the indicators in different classes, like extension signals, like trend direction signals, etc. Similarly, breadth indicators also are grouped under different categories. Some are custom index kind of categories, like mega cap index, leader index, total view index, and global index. They are custom indices, special indices built in Q Global. Another category is percentage moving average studies, how stocks are moving relative to moving averages across different indices. So percentage of stocks above 50-day MA, above 200-day MA, and percentage of stocks where 50-day MA is above 200-day MA. We have three indicators in this category, percentage MA studies. So custom index, percentage MA studies. Then we have more categories. Market internals. These are advanced decline, up down volume, new high, new low percentage, 3-month new high low. These are the 4 market internals. They are neither custom indices, they are not percentage calculations related to moving averages, they are market internals. Advanced decline, up down volume, new high, new low percentage, 3-month new high. Now note the naming is done carefully. If the internal name has a minus sign, like advanced decline, up, down volume, 3-month new high low, they all have the dash or minus sign. then it calculates the delta. So advanced decline means it is number of stocks advancing minus number of stocks declining. However, this market internal new high, new low percentage don't have the dash. So it's not a delta. It is the absolute numbers for new high, new low percentage. We'll read it later on the chart, but that is the way to read the internals. Not all of them are deltas. 3 of them are deltas, but not new high, new low percentage. That is the absolute number. And we can know that by not having the minus sign or dash in the name of the new high, new low percentage. That was intentional. Naming was intentional. Then we have another category of breadth signal, accumulation distribution. It is not custom index. It is not moving average related calculation. It's not market internal. It is accumulation distribution unique to Q systems. They show broad and significant buying. It has to be broad and has to be significant, both buying or selling in the market. Buying will show as accumulation, selling will show as distribution. That's another category. Then we have overbought, oversold signals. We had overbought, oversold signals in Q global. Those are technical signals related to one instrument. Usually we study them on stocks or Forex or ETFs or futures. But now we are talking about overbought, oversold signals that are market breadth signals. That's not about one stock. That's about the whole market. Very powerful. All of these signals are very powerful because they are about the internal health. One is BANGO, or buy everything, possible irrational exuberance, and sell everything, or bingo, even sell those of value. BANGO is buy everything, even those of not value, not enough fundamental value. Buy everything, BANGO, sell everything, bingo, possible irrational exuberance. Now, BANGO, bingo, these, I'll come back to that. Not only those, let's cover Eureka Phoenix. So another category is turnaround alert. A turnaround may appear, or strength of the market may be changing after these signals. You see, this is also a different category. It's not custom index. It's not moving average calculation. It's not market internals. It's not accumulation distribution, not overbought, oversold. It's turnaround alert signal, bullish follow through or Eureka, bearish follow through or Phoenix. You may also read them as Eureka as bulls are in control and Phoenix bears are in control. Not for a stock, but for the whole market. Or I may say across a dimension. Dimension is one index. We'll later see which of these signals are applicable to which indices or dimensions. And then we have another turnaround alert signal, Hindenburg. Now, BANGO, bingo, Eureka, Phoenix, Hindenburg, they were created by a great gentleman whom I never met, but I heard about him from many people. And these are were created by Ian Woodward, may him rest in peace. They are very useful. They are HSI-like signals, may not exactly match HSI signals, but you may use them in lieu of HSI signals. They are different because maybe slightly different. I cannot say different. They are maybe slightly different because the data sources are different. And maybe HSI has calculated with little different values because of the data source difference. We use very reliable data source. So I have seen sometimes the signals may not appear on the exact same day. So Hindenburg may not appear on the exact same day all the time. But any one of the systems can be used, and I rely very much on Refinitiv data, very reliable data. So I have started having full confidence on the Q-Bread signals that are Bango, Bingo, Eureka, Phoenix, Hindenburg, all designed by Ian Woodward. Then we have few more categories. Later on, if you go through these categories, you will see there are many categories. Together, they tell a perfect story about the market. These are comparison relative studies category, growth versus value plot, and small cap versus large cap. They show relatively is growth doing better or relatively small cap doing better. And then finally, another category, total view. It summarizes the insights from all the dimensions, and dimensions are nothing but composites or measured indices. Why I call them dimensions? Because aggregation is done across them. And total view is a unique breadth signal which combines the breadth signals from different dimensions, and they are plotted on a single chart. Very powerful chart. Lot of signal, color coded signal, but very powerful chart. So these are the categories. All distinct purpose, all very powerful. Together they tell the perfect story. Now let's go through all of them one by one. Starting with custom index, mega cap index. Mega cap index aggregates the top mega cap stocks in a single candle chart. We don't read all the mega cap stocks or FANG stocks or different kinds of mega caps to see how they're doing. Just looking at the custom index, mega cap index, we know how mega caps are doing. Why it is important? The market indices are often weighted by market cap. That means the indices moves are heavily influenced by how mega caps are moving, because the mega caps in the USA have market caps that are much, much higher than average stocks. So if the market indices are market weighted, mega caps move. If mega caps are going up, market will most likely go up. If market goes down in spite of mega caps going up, then we have to know that many majority, almost all the stocks, probably very high percentage of stocks are going down. And we'll be able to read that from other breadth layouts like advanced decline signal, up down signal. How mega caps are doing, we can read from mega cap index. Nasdaq 100, S&P 500, Russell 2000, all are market cap weighted. Not that all of them have mega caps. Russell 2000 don't have mega caps. They're small cap index, but they are all market cap weighted. Dow Jones Industrials Index is not market cap weighted. Stocks in general tend to move in the direction of the major market indices, the external view. Therefore, studying the mega cap custom index gives valuable clues regarding how the market indices and the stocks in general will move. Mega caps, because indices are market cap weighted, will influence the indices, all the indices, except Russell 2000, except Dow Jones. Because Russell 2000 don't have mega cap, Dow Jones doesn't have market cap weighting. But other than that, all the indices will move along with the mega cap. And mega cap custom index in Q Global is comprised of 20 biggest mega cap stocks. Not all of them are tech stocks. In a bull market, the mega cap index moves in an uptrend. If that uptrend is broken, you may be cautious about buying more and more stocks. Sometimes the mega cap index may be used in another way. If the mega caps are moving sideways, and this happened a while ago, mega caps, if they are moving sideways, then we look at other breadth signals. Use the Q breadth studies, and you may see if non-mega cap stocks are rotating in favor, and buy those stocks instead of mega caps. How? While checking such alternate stocks, focus on index stocks that are not influenced by mega caps. So mega cap custom index, we see it is moving sideways. Well, then we look at the market breadth layout for Russell 2000. That is not influenced by mega caps. There is no mega cap. It's a small cap index. Then we look at its internals, advanced decline, up, down, volume, etc. to see is Russell 2000 or small caps in favor. Or we could look at Dow Jones Industrials. It's not market cap weighted, so mega caps will not influence it abnormally. Again, do we look at the Dow Jones futures or ETF only? No, we look at the market internals for Dow Jones using the breadth layout. Look at advanced decline, up, down, volume. See, even if mega caps are moving sideways as seen by the custom index, are there internal strength in Russell 2000 or Dow Jones? If so, then we may focus on buying stocks that are small cap or that are industrials. That's how we may combine the insight from different market breadth layouts to come to a very useful trading decision at the market level or kind of stock level, small cap or industrials. Small caps sometimes rotate in favor over mega caps. The same may be true for industrial stocks in Dow Jones. You may focus on such stocks when mega cap custom index chart is not bullish. Why I didn't tell to focus on S&P 500 and NASDAQ 100 is because if mega caps are moving sideways, S&P 500 and NASDAQ 100 will be very heavily influenced by that sideways move of mega caps. So we may buy a stock and then get stopped out easily, whipsawed by the move of the mega caps. The individual stocks were not supposed to do like that. But focusing on Russell 2000 or Dow Jones will alleviate that problem because mega caps moving sideways will not have any impact on those two indices. So again, we don't look at those ETFs or futures only. We look at their true internal health before deciding on the directional bias of a particular category of stocks like small cap or industrials. That is how we use the custom index, mega cap index. And let's look at some chart. I'll read the text by each point. Point number 1. This is a stock. This is not a stock, it's the mega cap custom index. It represents the top 20 mega cap stocks in the USA market. It's a custom index, but you study it just like you study any instrument. You can use all the Q signals to study mega cap index like you would do for any single stock. Here, after displaying the bearish headwind in a weekly chart, and we know we have already gone through the Q global signals, we know it's a backdrop template. After displaying the bearish headwind in the weekly chart, mega cap index pulled down. The market had also pulled down along with it at that time because mega caps have outsized influence on the market. Russell 2000 different, Dow Jones Industrial different, but mega caps coming down in this period for sure made S&P 500, S&P 1500 and NASDAQ 100 come down. After this correction, point number 2, let's read the text. Mega cap index rallied and market also rallied. The rally was capped by another bearish headwind. Number 3, mega cap index then moved sideways in this period. However, the broad market continued to go up. You could identify stocks in favor in this period and buy those instead of buying mega caps. And which stocks would be in favor? We could know that from other breadth studies like breadth layout of Russell 2000, breadth layout of Dow Jones Industrials, looking at small cap versus large cap, value versus growth. From all those studies, we could see that, well, mega caps are moving sideways. Which stocks are least risky? Highest probability trades will come from where? We could know that. In this period, we avoid buying mega caps. At the right edge, let's read the number 4 point. At the right edge, mega cap index has not broken the uptrending memory trend line. This is the weekly chart. If that is broken, mega caps will turn down, and that will put heavy bearish pressure on the major market indices and the broad market as a whole. That will be a time to be extra cautious about buying stocks. Instead, you may look to protect profit in existing long positions. This actually happened. This is a recent chart. Soon after this period, mega caps actually broke down and the market also broke down. So we read the mega cap, see how mega caps are doing. It helps in 2 ways to decide whether to trade mega caps or not. In this period, for example, we'll be happy to buy the mega caps using a trend following flow bullish setup. But in this period, we'll stand aside from mega caps, we'll focus on other stocks. And we'll, of course, combine the Q Global's full strength. We'll use all the charts, whether support resistance, backdrop, entry template, volatility template, squeeze release, the full Q Global sets of indicators we can use to study the mega cap custom index. Then another custom index, leader index. Leader index serves the very useful purpose of knowing when to stop buying growth stocks in the later stage of a bull market. It's important to read the wording carefully. In the later stage of a bull market, this leader index is very useful. Leader index, as the name suggests, is comprised of leading stocks in all the sectors. What is a leading stock? For the purpose of leader index, it's a technically leading stock, price strongly going up. That's a stock that is steadily going up in a bull market, forming a lower left to upper right candle pattern on the daily chart. Leading stocks may not be at a buy point. That's not the purpose of studying the leader index. Leading stocks may be often extended. The purpose of using the leader index comprised of leading stocks is to see when leaders are broken. It's not used to decide when to buy the leading stocks, to decide when leading stocks are broken. And if leading stocks are broken, in general, growth stocks will be risky to buy. Leader index is a custom index created by selecting a few of the leading stocks in each sector. So it's not sector specific, it represents the growth stocks in all the sectors. Usually growth stocks, when they go up, they will go up in the leading stocks at the bottom left to top right pattern on the Q Global charts. So we take the few leading stocks, the top few leading stocks from each sector, create the constituent stocks, and then create a custom index for leader index. Because it's moving from bottom left to top right, it will usually have a memory trend line support, one or multiple. When the leader index breaks down below those or that memory trend line, and sometimes if it is moving sideways, it may break below watermark pivot support, that often signifies that growth stock rally is over. And that happens again and again and again and again in every bull market. And remember, it's about growth stocks. Not all stocks rally will be over. We'll still have plenty of opportunities, and we have comparison indicators, right? So we can see growth versus value. Growth rally may be over, but value stocks may be doing better. And usually Q traders will always find some stocks to trade. Once the leader index is broken, the constituent stocks and growth stocks in general may correct by a significant percentage. After reaching the peak, 50% or more correction is not uncommon. It's not based on my research, but the general thought is that after reaching the peak, growth stocks, high earnings growth stocks, correct a lot. How much? The general saying is 50% of them goes down by 80% from the peak, and 80% of them goes down by 50% from the peak. It's not 80-20, but little bit different. 50-80, 50% goes down by 80%, 80% goes down by 50%. So that means it's important, if one is focusing on growth stocks, to book profit. We will not be able to catch the absolute top, but book profit in a timely manner, maybe using trailing stop, maybe using trend line break, maybe using some of the direction line breaks. And that is about a particular stock, how to exit a growth stock at a higher price level. And how do we know when to stop or slow down buying growth stocks? That's by studying the overall leader index. If the leader index is broken, we certainly slow down, may even stop buying growth stocks. And then another new bull market will start. In the subsequent bull move, the leading stocks may not be the same. Usually they are not the same. Often different stocks lead in a subsequent bull market, and you and I will create an updated leader index. Once we create the updated leader index in a new bull market, we don't have to change it until that leader index is broken. Now the leader index is actually broken. We look at it in Q systems. All you need to do is update the stocks in the downloader folder, and the leader index will be auto calculated. At present, what are the stocks in the Q Global Leader Index? They're the stocks that Dr. Jeffrey, probably you all know of them, know about him, not them, know about him. Very accomplished trader, very wise person, and shares his trading ideas regularly in YouTube videos. He created a list of leading stocks in one of his online meets, and I'm using those leading stocks to create the leader index. Currently, actually, that leader index is broken. In subsequent bull markets, you may update the list of leading stocks, or you or I may watch Dr. Jeffrey's videos, and if he's updating the list, I may simply use the list, or you may use that list to update the stocks in the downloader folder. If you don't want to use his list, you may always look at the stocks in each sector that are going bottom left to top right, this kind of pattern. Get 2 or 3 stocks in each sector. There are 11 sectors, so there will be about 20 stocks or so, 20 plus stocks. Get 2-3 stocks in each sector, bottom left, top right, in a bull market, and update that data. But currently that leader index is broken. We'll wait for the next bull market to start. Again, the leader index is not used to time entry in the leading stocks. By definition, they are extended because they have already displayed this move, bottom left to top right. They are already extended. If you are conversant with IBD or CAN-SLIM style, they may already be in base 3 or base 4, maybe in base 5, in late stage bases. They are not entry signals. The usefulness is the breakdown of the leader index, not to time the entry in growth stocks, when to pause or stop buying growth stocks. Here is an example, all recent examples. I'll read by the numbers again. In this area, the leader index rallied. If you notice the Q Global traffic color, and using Q Global, you instantly know what chart template it is using. It's using the entry chart template, traffic color, and flow colors for candles. So in this area, by definition, leader index constituents go from bottom left to top right, bottom left to top right. And in this period, the index, custom index itself was also doing that. And the traffic light colors, all these never turned red. One time only turned yellow. All the candles were green. And at that time, you can imagine there was surely memory trendline support hugging the low of these candles. It went up with a strong uptrend without much of a pullback. It kept on making new highs. That is the typical move of the leader index in the bull market, not the early bull market, because the stocks needed to display bottom left, top right axis is already sometime into the bull market, maybe in the late stage of the bull market. We will not know when it is late. Beforehand, we'll know when the leader index is broken. Now see number 2. The leader index now changed character. Traffic light candle color frequently turned red, lots of reds. It failed to make new high. This was the peak with a long upper tail. After that, it failed to make new high. The index started making lower lows. In this area, there was no lower low, but after the peak, traffic light color started becoming red, started making lower lows. At the end of this phase, the leader index, in fact, came back to the very long-term memory support. So it started weakening and came back to a long-term memory support. And you may say very precisely stopped there. It is not one stock, it's a custom index. So this is precise enough. It stopped at the trend line support. So the initial sharp rally, if you notice, this slope increased a lot from here, and the trend line was created from that point. That was one anchor point and another anchor point from the past. Price came back to the trend line created by the anchor point from where the sharp rally started. This is the place from where the bottom left, top right rally started. We can know that by studying the leader index. And isn't it amazing how the trend lines work, the memory trend lines? Price came exactly to the same level, precise enough, and then went up from there. Now, number 3 at the top, the leaders stopped leading from this point, from here. They stopped leading because why? The tight up move pattern was broken. This was a very tight. Loose pattern will be like this. And tight pattern is where there is not much variation in price. Price is steadily going up, but not volatile in a lot. So that's a tight pattern. The tight pattern vanished from this time onward. And you would be cautious from that time. You could protect profit in constituent stocks and growth stocks in general, not only or and growth. If the leaders break down, others will also likely break down. So constituent stocks and or growth stocks in general, you will be cautious. And then at the right, the leader index is now range bound. Again, we are using the Q global technique to study a custom index, leader index. Range bound, why? Because it is bound by trendline resistance and support. The same stocks may not lead in the subsequent bull run. And I'm resisting myself to open the live charts as of today because that will take longer. It never recovered from this time onward. This is a chart from some time ago. I in fact started preparing for this class quite some time ago, but stopped taking the class because of the MetaStock upgrade I was expecting. And These charts were created using 17.5, but that's fine. So that's how we use the leading index, not to time entry into growth stocks or leading stocks, but to know when the growth stock rally may be over. Then another custom index, total view index. Q Market Breadth has a unique single chart view of the market called total view. Very powerful, very informative. Market Breadth total view is discussed in detail in later slides. The candle chart in Market Breadth total view is not that of any single major index or composite index or ETF or future. It is a total view custom index created from multiple major indices and composites. So it shows the overall picture. This more accurately represents market's true total view. That's why it's called total view, not one index view or composite view, total view instead of any single ETF or future. Total view index can be studied just like any other stock or ETF. All the Q global templates can be used. Therefore, we are able to know the market direction using direction lines of the market as a whole. That's important, not just one index like NASDAQ 100, or some people like CanSlim traders often focus on NASDAQ composite, but that's not required. We can do that. Of course, we have a NASDAQ composite market breadth layout, but this total view is more powerful because in a single chart, it shows the overall view. Not only market breadth, we now use the Q global charts to study all technical signals, directional signals, overbought, oversold, or extended condition using stretch signal, jump thrust, etc. Support and resistance using memory and watermark, reversal possibility using headwind indecision, all the Q global techniques. And this is one more reason Q traders are much more accurate, much more often about market tops, bottoms, when to buy, when to stop buying, when it's safe to buy, when it is better to pause because it's already up somewhat, or maybe there is a trendline resistance nearby, maybe there is a bearish headwind signal, maybe jump thrust has hit upper extreme. Using all the Q global signals on the total view, we are able to do better assessment of directional bias. I explained that in every weekend recap, and once you go through these insights from this class, I think you will be able to do it even better. I guess so. And this is an example of market breadth total view using at a glance, that is the backdrop weekly and entry daily chart. Very powerful. Combining the custom index with the Q global technical signals. Let's read them. Let's start with A. And under A, we have different numbers. Total view index analyzed using at a glance weekly daily. Point number 1, very, very powerful signal, the trend line support. When total view index came near the daily memory trend line support, you could start to identify strong fundamental stocks for buying. And this was a sharp drop. If we did not have the trend line support and not on a particular index on the total view, we would not have enough confidence to buy. But we had a trend line support. Non-Q traders will not have this support. So we could start to buy and read on. Weekly was also at memory support at the same time. So we had further reasons and further confidence to buy. You could buy even more confidently when total view displayed the bullish headwind here. All the Q global signals are coming together to tell us that we buy. Very few people, in fact, bought at the bottom. And if you followed me on the weekend recaps or on the forum, you would know that I was starting to buy. And this you can see again and again. Me or any other global trader, market risk trader, they are able to time the bottom and top much better because we are able to look at the custom indices with full array of Q technical signals. Using Q global index in this way along with other Q breadth insights. And when we observe these signals, trendline support, bull release also, bullish headwind also, we didn't just look at the total view custom index. We looked at the market breadth internals. We looked at all the breadth signals. You would be, and I was, you were, if we are using, were able to buy strong fundamental stocks even before, and this is important, even before the follow through day appears. Can slim traders follow the principle of follow through day? And HSI traders follow the principle of Eureka Day, but using the Q global signals on the total view and then combining the other breadth layouts, you could buy at this point. There was no follow through day, there was no Eureka Day, but you could start to buy with very high confidence because those trades are still high probability trades and low risk trades. The swing trades taken in this way before a follow through day would still be high probability and low risk. Low risk because trendline support is very near, stop will be narrow. High probability because these Q signals work very well. Trendline support, bullish headwind, oversold condition, and then bull release, they come together, give us a bounce setup, maybe give us a box setup. We could buy from then itself. We would not wait for, and again, we would not wait for follow through day or Eureka Day. And look at the point B, another time the same trend line support. And notice it is coming from far away. This should be another time to buy stocks at total view index bounced up from the same memory, and in this case also a watermark support with bullish pressure. Bullish pressure. Again, I'm using the full array of Q signals to analyze the custom index total view. Very powerful. We could buy before follow through day, we could buy before Eureka Day with high confidence. Still we would have and did have high probability low risk trades. And we would also know when to stop. When price came near the trend line support, we would not buy at that time. Incidentally, Eureka Day, follow through day might have come here, who knows? Usually follow through day by definition means it will not come at the bottom. It will come after some time. That is the definition of follow through day in CAN-SLIM. And Eureka also may not come at the bottom. Remember, bounce is an extreme reversal setup. Hit the trend line support, immediately goes up. There is no delay. Trend line is plotted without delay. So bounce setup can be the fastest reversal trade possible. And we have the bounce setup. So we could use it very confidently. We would also know when it is a bit late to buy. Then another custom index, the last one, that is the global index. All the markets are nowadays linked. For example, banks are linked in a way by interest rates. Metal stocks are linked by the price of the commodities. Same for oil. IT stocks are very large. IT stocks are now global stocks, multinationals, very large global stocks. They are affected by different countries' economies. So they are all related. We may study different countries' market index or not, I will not say or, in a way or, because we are not going to go through all the markets indices, not required. We could study the global index using the custom index, Q global index. It is comprised of Australia, Japan, China, UK, India. Global X North America. The global index shows in a single chart how the global markets are doing. Why not North America? Because North America is a very huge market. It influences everything. So for North America, we already have the other breadth layouts. Most of the breadth layouts, as I mentioned, they are calculated on North America, and global index is for X North America, global index, single chart. Because the global economies and therefore stock markets are interlinked, it is useful to keep an eye on the global index, even if you are not trading in any of those global markets or trading in only a few of the constituents. So if you are in Australia, probably you are trading Australia, and probably you are trading USA also, is the largest market. If you're in Japan, probably you are trading Japan and USA. Same for China, UK, India. If the global index is strongly bullish, then it is less likely does not mean it cannot happen, but less, or you may say even very less likely. If global index is strongly bullish, very less likely that USA market will break down suddenly, and vice versa. They are all linked. If the global index is breaking down, it is likely, not guaranteed, but likely that sooner rather than later, the USA market will also break down, and vice versa. Now, if you notice these global markets, they all open before the USA market. Japan opens first on Monday, then, not Japan. Australia opens first on Monday, then Japan, then China, actually, then India, then UK. They all open before the USA market. So in a way, if you study the global index, you have some idea what can be expected. They are not perfectly correlated, but if the global index is heavily coming down, you can expect that Indian market, USA market will have a similar move in the market hours. Very useful. I look at it every day. I share it also in the weekend webinars. And once again, just like other custom indices, we can use the full array of Q technical signals, Q global signals. At the right edge, and this is global index, using Q entry daily chart. At the right edge, the global index is moving sideways. This is not bearish yet. At the time this snapshot is taken, USA total view custom index is also moving practically sideways. Remember, in USA, we have a total view custom index. Individual indices might be moving up or down, but during this period, the total view index, very interesting. If you observe, total view index was practically moving sideways. Meaning sometimes maybe bigger players are buying small cap, then large cap, then industrial, then tech stocks, then mega cap. But overall, the total view custom index was actually moving sideways, or practically sideways during the period. Global index was also moving sideways. Now, when I created this, I commented if the box created by the watermark pivot levels, this is the box created by watermark pivot levels 1 and 2, is broken, which will also mean that the longer term memory trend line support, that is this line 3, is broken. That is, if price goes down below that, that will likely coincide with a similar weakness in the USA market. And this I created some time ago. And in fact, the exact same thing happened. The global index broke down and USA market also broke down. Again, particular USA index might have broken earlier, but the total view index was moving sideways mostly when global index was moving sideways, and they broke down. One might have broken down a bit earlier, but both of them broke down eventually. And we could study the global index to have an idea what is more likely going to happen in the USA market and vice versa. Why global index is important? Though USA market is the biggest one reason is they all open before the USA market. They close before the USA market. So you can anticipate sometimes what is going to happen, especially when the global index has very big moves up or down or a breakdown below a level. In fact, yesterday I was talking with a trader in the USA and I noticed the global index recovered. Though it started lower, it recovered, and I was actually studying individual indices and they all recovered, but that would be reflected in the global custom index also. And I mentioned the USA market may do the same thing, and the same thing happened yesterday. The more you study, the more you will see the correlation between global market and total view custom index. And remember, I told when the global index was moving sideways, USA total view was practically moving sideways, and this is the confirmation of that. In this period, this is now the total view custom index, not one USA index, but total view index, overall picture. They also, or it also created the same box pattern when global index was moving sideways. At point A here, it broke below the watermark support, and global index also broke, but USA market here broke more deeply, but global index did not break so deeply. So one was going to follow the other. So in fact, in this case, USA market went back inside the sideways range as seen from total view custom index. It recovered back inside the box. This is USA total view. Now, if the USA total view falls below the watermark support again, this watermark support, it would have created a dead cat bounce if this was broken. The slide was created some time ago. The global index will also likely break the watermark pivot support, and exact same thing happened. This was created some time ago. After some times, the global index and USA total view, this is the total, both broke below the box. They are related. I'm trying to clear all the drawings and clicking on mouse, but it is not coming back to mouse. Why? Let me draw something. Mouse, clear all drawing. Okay. So that was one category of breadth indicators. We just cover one category. Already 1 hour, 20 minutes. Let me cover at least one more category. Breadth signals, MA studies. We covered custom indices. Now another category, MA studies. The percentage MA studies show market breadth by aggregating stock moves around major moving averages. Many traders observe these moving averages on stocks and on indices, but this is much more internal health study than just studying the moving average on stock or ETF or future. It's percentage movement, percentage of stocks moving across MA studies plotted for major market indices and composite indices. I'm also going to mention which study is applicable to which dimension. So percentage MA studies are applicable to major market indices like S&P 500, Russell 2000, NASDAQ 100, and composites like NASDAQ Composite, NYSE Composite. And because the market the total view aggregates everything into a single chart, they are also plotted for the market breadth total view. There are three percentage MA studies. Percentage of stocks above 50-day MA. This is the most sensitive of the three studies. Percentage of stocks above 200-day MA. Sensitivity is in the middle. And then percentage of stocks where 50-day MA is above 200-day MA. This is the slowest of the three studies. Continuing. Percentage MA studies give early signal of market weakness in a bull market. Market ETA for future may still be holding up, but individual stocks, less known weak fundamental stocks will start to come down before the overall market indices come down. Why? Again, market indices are heavily weighted, influenced by market cap. And very large market cap stocks tend to be stronger. There are many weaker stocks. They will start to come down, and that will result in percentage MA studies tilting down. That's why they are able to give early signal. Most of these breadth insights or internal health indicators will give early signal. So percentage MA studies give early signal of market weakness in a bull market and early signal of market strength in a bear market. They tilt down before the major indices roll over at the end of the bull market. Of course, the bigger players will start selling the weaker stocks first, and there are many more weak stocks than the strongest stocks, best fundamental stocks. So these studies will tilt down before the major indices. Tend to show bearish divergence as well at the end of a bull run. Once such weaknesses are shown, either bearish divergence and or tilting down of the percentage MA studies, you may focus on protecting profit in existing long positions instead of keeping on buying more and more stocks. That's the overall view. Analyzing the percentage MA studies for various major indices and composites. Now we are drilling down. We could study percentage MA studies on total view, and then we are going to look at individual dimensions, major indices, S&P 500, NASDAQ 100, Russell 2000, etc., and composites, NASDAQ Composite, NYSE Composite. That will give further idea, more clear idea where the strength is there, if at all, in the current market. And you may focus on buying in that area. So total view may be showing that percentage MA above 50-day moving average tilting down. So you know market is weakening. Then you will drill down to see, is there strength in small caps by studying the market breadth layout of Russell 2000, or is there strength in NASDAQ 100? You can study the individual breadth charts. And also breadth charts, you will also look at the percentage moving average studies for the individual indices to see where the strength is. For example, broadly analyzing if NASDAQ Composite percentage MA studies are weaker than NYSE percentage MA studies. And this is what is actually happening now. For many months, I'm showing in the market recap videos, and you must have observed it if you are using Global Breadth, that NASDAQ Composite percentage MA studies are weaker than NYSE. Then you may avoid buying NASDAQ stocks. The more we are focusing on the stronger stocks to buy, the more we are resulting in higher probability stocks. Does it mean we could not buy NASDAQ stocks and make profit? Yes, we could do. But this is yet another edge in our favor. If we already know from percentage of studies that NASDAQ is weaker than NYSE, NYSE has enough number of stocks, why not focus on them? You may further observe then the percentage MA studies for the major indices. If you see, for example, that NASDAQ 100, again tech stocks, but not composite, narrower, Nasdaq 100 is weaker relative to others, that will provide further reason to avoid buying tech stocks. And then, of course, you can study the sector performance using Q edge. There, if information technology is weaker than others, again, we'll have another signal from a totally different angle telling that don't buy tech stocks. And sometimes it will tell us to buy tech stocks. Currently, Nasdaq stocks are weaker. This was created some time ago. That time it was true, and now also that is true. Continuing, percentage MA studies may also be used as broad overbought, oversold indicators, and I explained that in the market recap videos. On the Q breadth charts, the 20% level and 80% levels are automatically drawn. If percentage of stocks above 50 MA falls below 20% level, while being in an overall bull market, you may anticipate a potential reversal and identify strong fundamental stocks to buy. So another market internal that lets us buy little bit ahead of others, because we can anticipate a bounce more often than not when percentage MA falls below 20% level, because that is oversold condition. Now we are using it as an oversold, overbought indicator for the whole market using percentage MA studies. How to identify an overall bull market? That is identified in weekly charts. In Q system, we simplify. You just look at weekly charts. If the weekly chart of major market indices, or you may look at the market with total view, is in an uptrend, then we are in an overall bull market, simplifying things. If the weekly chart is in an uptrend steadily going up, then every time the percentage of stocks above 50 MA falls below 20% level, we may expect a bounce. And what kind of stocks we are going to buy? The stocks that are the strongest fundamentals, which industries that are now tilting up or accelerating, and which kind of technical setup? One of the Q technical setups. So again, we will focus on the strongest stocks, but we will be a little bit ahead of others. And then again, if multiple major market indices and their composites are hitting oversold level together, that may increase the potential for a recovery rally for the broad market. For individual dimension, let's say Nasdaq 100 or Nasdaq composite, if it is hitting 20% oversold level, we can start to look for buy setup. And if Nasdaq composite, NYSE composite, Dow Jones, everything is hitting 20% level, then we can expect a recovery rally. And if you are using QH, you know, we can get similar similar concept, but from totally different calculation from bucket analysis in QH. You may identify strong fundamental stocks to buy. However, when we have oversold condition, you may not actually buy them unless the percentage MA studies tilt up, meaning we don't catch a falling knife. Percentage MA study might have hit the 20% level, just like is true for individual stocks. You will notice none of the Q buy setups, bounce, box, headwind, pullback, flow, none of them tries to catch a falling knife. They always wait for a move up, but the optimal location, not after it has already moved up for if it is the optimal time, whether it is bounce, box, flow, everything optimal. It tries to catch the tilting up of the move. The same thing we are doing for percentage MA studies. It hits the oversold condition, but we don't buy when it is still falling. We wait for it to tilt up. It doesn't necessarily have to go above the 20% level, but it has to tilt up. And in fact, this I showed just a while ago in the market recaps. The same thing happened. We could use it to time the market. Again, we are not necessarily waiting for follow through day. We could do that, but we will be a little bit late. Not required to be late, because we have the trend lines we could use to study market the total value, then we use all the other breadth signals. You will see how beautifully everything will come together when you finish understanding all the breadth signals. So you may start looking for stocks to buy, great fundamental stocks, but not buy until the MS studies tilt up. And of course, this is always true. The individual stocks give a proper Q trade setup. Now that is true in a overall bull market. In a bear market, the percentage MS studies may remain oversold for extended periods, and you may not want to buy stocks based on oversold condition alone. Look for additional bullish market and breadth signals before starting to buy stocks. What breadth signals? Will see advanced decline stocks, up down volume, new high low percentage. Are they also going up? If they are going up, then we know that from oversold condition, now internal health is becoming healthier. Maybe we'll see a bullish divergence in advanced decline, or maybe we'll see advanced decline has turned bullish overall. We can know that from those individual indicators. So we could look for additional breadth signals to see enough bullishness before buying if we are in a bear market. Just hitting oversold condition will not do that if it is in a bear market. This is an example of the percentage MS studies, 3 of them. The convention is yellow is above 50-day MA, white is above 200-day MA, percentage, all are percentage, and 50 above 200 MA is orange color. See this area, the yellow line tilted down, but the index went up. This is one of the USA composite indices. Between these 2 days, the composite index made new high. However, percentage 50 MS study, and that is the most sensitive one, came down and closed below the midpoint 50% level. That's another way to use it. 50% is the midpoint, this gray line. So it had a tilting down. It also came below the midpoint, neutral point, and showed a bearish divergence, exactly what I mentioned. By definition, the percentage MA studies will always show the weakness before the market indices by definition. They may coincide, but mostly, in my experience, they always, especially the most sensitive one, yellow line, will always tilt down before the market starts to go down. Leading indicator, true leading indicator. And this resulted in the composite coming down. So when we saw it's already made a lower high, lower low from this point onward, but the index was still going up, making a new high. We will be cautious. We will not buy from now because we already know that market has weakened, already weakened. And the moment we had a drop here, I am pretty sure we could short a lot of stocks. We would be ready with those stocks, overvalued stocks in weak industries, giving a proper Q short setup. And this was a true case. All are true charts, of course. If you used the percentage MA studies, the yellow line, especially the most sensitive one, you could know exactly when to stop buying. This was clear signal that stop buying, because under the hood, market was not strong. There is no judgment. It's pure data driven. Some more analysis, and red line here, this is the 20% level. Oversold condition is the 80% level. Overbought condition, midpoint 50% level. We have 3 horizontal levels, and the percentage MS studies are drawn between those levels. At point 1, what I mentioned, percentage of stocks above 50 MA hit the oversold level of 20% for a composite. This is one of the 2 USA composites. You could buy fundamentally strong constituent stocks with proper Q trade setup at this point. You again would not need to wait for follow through day, or even if it was a sharp down move, you would not need to wait for follow through day or Eureka day. You would use individual Q trade setups because it was oversold. Remember, we don't catch a falling live. We would wait for it to tilt up, and then that tilt up meant some stocks must have gone up. Which stocks? Usually the best stocks would go up first, and we would be able to identify them using top down or bottom up analysis. Those trades taken at the bottom when the yellow line tilted up, and you will notice the follow through day would have come later. It will never come when the yellow line tilts up by definition. Those trades would likely make a profit as the composite went up from the oversold level. Of course, the strong stocks would give us enough profit by the time the yellow line went up, by the time the composite tilted to this level. 1, 2, 3, 4, 5, 6 days rally. This is enough for us to book profit in the swing trades, at least partial position, and we might hold remaining position with the trailing stop. That's the standard practice. Let's see if I have more slides on percentage MS studies. After that, I'll stop today. This is one more chart, again on percentage MS studies. Point number 1 first. Here, as I mentioned, going below the red line was not enough. It went deep below the red line level, that's 20% level. And not only the yellow line, but white line, and eventually the orange line also crossed below 20% level. Of course, yellow line crossed first, then white, then the least sensitive, the orange line. All the 3 percentage MS studies fell below 20% level, showing severe oversold condition. Again, the yellow is the most sensitive. The oversold condition remained for a while, this elliptical area. They didn't start to tilt up. The yellow line was flat. White line was also flat. Again, yellow is more sensitive. You would wait for the index to move up and for upward tilt of at least percentage 50 MS study, the most sensitive one, before buying from such oversold condition. So we could start to buy from here. And point number 2, once the up move started, percentage MS study quickly hit the 80% level. Amazing, isn't it? Cross the 20% level here, hit the 80% level quite quickly. And the index might not have gone up so much, but internally, I'm not sure because the chart may be compressed on the candle chart. The scale may be compressed, but see how rapidly, this is a daily chart. By the way, the percentage MS studies are usually studied on the daily chart. And this is a daily interval chart. So you know how fast it went from 20% level to 80% level. That shows that you could make a considerable profit by timing your entry based on the recovery from the severe oversold condition shown by the percentage MS studies. Are you going to use only the percentage MS studies to time the entry in the strong stocks? No, we have the full picture. I'm explaining each indicator one by one, and this was a powerful signal that the yellow line was flat and then it started to go up. You could start to buy fundamentally strong stocks well before it hit the red line. And even if you, of course, I wouldn't wait for it to go above the red line. Already we had an uptrend in the yellow line. Yellow line is also going up zigzag fashion, higher high, higher low. The moment we have higher high, higher low, or just higher high and higher low and anticipatory higher high, we could buy, just like we do using flow setup, applying that concept to the yellow line. And very high profit could be made if you are used to booking partial profit and holding on to partial position. Or if you are a longer term investor or position trader who don't sell so quickly, like for example, CAN-SLIM traders. It's not that CAN-SLIM traders cannot use. In fact, I think in terms of market level study, Q-Breadth study far outperforms what CANSLIM does, because CANSLIM mostly look at the external view. HSI looks at some of the internal views, but Q, of course, has incorporated the HSI like signals also, Eureka, Phoenix, etc. And it has many more signals. So Q Global Market Breadth provides the most powerful data-driven internal view. And I keep on saying that's why Q traders can time the market better at the market level. And then of course we have the Q signals at stock level. That was the last slide on percentage MS studies. Then we'll move on to the next category. We covered two categories of market breadth signals, the custom indices and then percentage MS studies. We have many more categories. We are at 1 hour 40 minutes level. And let me check the, let me close the slide. If I can get to my slide, where is my slide? I am on slide number 33. I have 60 plus slides. So we are not going to take another 2 hours today. That will be too long. Next session, we'll start with market internals. Then we have other categories. I will announce the time soon, date and time soon. I'll try to do it this week itself. Thanks a lot for attending. I look forward to seeing you in the next session, continuing session of the market breadth masterclass. Have a great day. And now using the market breadth studies along with other signals, no reason not to do that. Keep on trading profitably. Thank you.